In the heart of Omaha, Nebraska, there sits an office that is, by the standards of modern finance, an anachronism. There is no Bloomberg terminal flashing with a constant stream of market data. There is no wall of monitors tracking the frenetic pulse of global indices. There is, most notably, no computer on the desk of the man who runs the entire operation. For Warren Buffett, the chairman and CEO of Berkshire Hathaway, and one of the most successful investors in human history, the primary tool of his trade, the weapon that has allowed him to consistently outperform the sharpest minds on Wall Street for over half a century, is not a silicon chip, but a stack of paper. An endless, perpetually renewing stack of annual reports, trade journals, newspapers, and books. This simple fact is often treated as a quaint eccentricity, a charming quirk of an old master. But it is not a quirk. It is the very engine of his success. It is a deliberate, systematic process of information consumption, designed to build a competitive edge so profound that it borders on unfair. This is not about reading for pleasure. It is about reading for power. It is a strategic information diet. The central mistake that 99% of investors make is believing their job is to follow stocks. They track price movements, they listen to earnings whispers, they react to analyst upgrades and downgrades. They live in a world of tickers and charts, a narrow, two-dimensional reality broadcast by the financial media machine. Buffett, through his reading, operates in a different reality altogether. He doesn't follow stocks, he follows businesses. He doesn't track price, he tracks value. And to understand the value of a business, he must understand the world in which that business operates. He must build what his partner Charlie Munger calls a, quote, latticework of mental models, a deep, multidisciplinary understanding of how the world works. His information diet is the raw material for this latticework. It allows him to assemble a complex mosaic of knowledge, connecting disparate dots from different industries and different eras to form a single, coherent picture of a potential investment. This process saves him from the single most costly mistake in the market, making a decision based on an isolated, out-of-context data point. It prevents the folly of seeing the stock price but not the competitive landscape, of seeing the quarterly earnings but not the shifting consumer behavior, of seeing the tree but missing the forest entirely. Over the course of our journey today, we are going to deconstruct this system. We will move beyond the simple platitude that Buffett reads a lot and dissect the specific methodology behind his information consumption. This is not merely an intellectual exercise. This is a financial transformation waiting to happen. By understanding how to build a superior information diet, you will learn to cultivate an information advantage. You will begin to connect dots that others miss. You will develop a more profound, more resilient understanding of your investments, leading to the kind of high-conviction decisions that are the bedrock of true wealth creation. Your information inputs determine your financial outputs. Today, we upgrade the inputs. We are going to explore the 5 core pillars of this billionaire's information diet, a system that has fueled a lifetime of market-beating returns and provides a blueprint for anyone serious about achieving their own financial freedom. We begin with the very foundation of his approach, the art of reading not for information, but for understanding. The first pillar, the very bedrock of Buffett's informational strategy, is the principle of building a broad base of knowledge before ever narrowing in on a specific company. It's the philosophy of understanding the entire ecosystem before analyzing a single organism within it. Most investors do the exact opposite. They find a stock ticker, and then they try to understand the business. Buffett understands the business, the industry, and the economic landscape first, and only then does he consider the stock. This approach requires an immense volume of reading that seems, on the surface, to be disconnected from the daily churn of the stock market. He is famous for devouring not just the Wall Street Journal and the Financial Times, but also obscure trade publications, biographies, and histories. This isn't a hobby, it's a strategic necessity. It's about building a rich internal database of how businesses and industries live and die, how competitive advantages are won and lost, and how human nature drives economic cycles. The perfect illustration of this principle in action, a moment where this broad reading translated into one of his most legendary investments, is the story of the Great Salad Oil Scandal and his investment in American Express. In 1963, the financial world was rocked by a scandal of almost comical proportions. A company called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis in Bayonne, New Jersey, had perpetrated a massive fraud. DeAngelis had secured enormous loans from dozens of Wall Street firms, including a subsidiary of American Express, using his inventory of salad oil as collateral. The problem was, the salad oil didn't exist. His massive storage tanks, which were supposed to be filled with millions of pounds of valuable oil, were mostly filled with seawater, with only a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied Crude Vegetable Oil collapsed overnight, defaulting on over $175 million in loans, a staggering sum at the time. The market panicked. American Express, through its warehousing subsidiary, was on the hook for a significant portion of the loans. Its stock, a blue-chip darling, began to plummet. Wall Street was convinced that the scandal would not only result in massive financial losses, but would also irrevocably damage the American Express brand, particularly its travelers' check and credit card businesses. The sentiment was that nobody would trust a company so deeply entangled in such a sordid affair. The stock fell nearly 50%, from over $60 a share to $35. This was the moment the 99% of investors were selling in a panic. But Warren Buffett, then a young, relatively unknown money manager in Omaha, was buying. He was buying with both hands. In fact, he would end up putting 40% of his partnership's capital into this one single stock. What gave him the conviction to make such an audacious bet against the entire market? It wasn't a hot tip or a complex financial model, it was his information diet. While everyone else was obsessively reading the sensational headlines about the salad oil fraud, Buffett was reading everything else. He had spent years reading Moody's manuals, devouring the financial histories of hundreds of companies. From this, he understood that American Express was not one monolithic business, but two distinct operations. There was the warehousing division, which was indeed in trouble, and then there was the core business, the traveler's checks and the credit card. The market, in its panic, was conflating the two. Buffett's task was to determine if the damage to the brand from the warehouse scandal would spill over and kill the golden goose of the financial services side. So he began a process of deep, on-the-ground due diligence. This is where his investment research went far beyond anything his Wall Street counterparts were doing. He didn't just read the financial statements. He set out to test the strength of the company's intangible asset, its brand. He visited restaurants and hotels. He talked to cashiers and travel agents. He stood in bank queues and observed customers. He was asking one simple question: are people still using American Express travelers' checks and credit cards? The answer he found was an overwhelming yes. The scandal, while a huge story on Wall Street, hadn't penetrated the consciousness of the average consumer. People still saw the American Express logo as a symbol of trust and security. He even went to his local travel agency in Omaha and watched as customers, day after day, chose American Express travelers' checks over all others. He saw firsthand that the competitive moat around the core business was not only intact, it was completely unaffected by the troubles in the warehousing division. He concluded that the fundamental earning power of the real American Express business was worth far more than the $35 the panicked market was asking for it. His broad base of knowledge allowed him to separate the temporary headline from the permanent business reality. He invested heavily, and within a few years the stock had risen fivefold, netting his partnership a massive $20 million profit. The psychological principle at play here, the cognitive bias that Buffett masterfully overcame, is known as the availability heuristic. This is our brain's tendency to judge the likelihood of an event based on how easily examples of it come to mind. The salad oil scandal was a vivid, sensational, and easily recalled story. It dominated the news cycle, For most investors, this story was so available in their minds that it completely overshadowed the more mundane but far more important reality of American Express's core business. Their brains took a mental shortcut. I can easily think of this huge scandal involving Amex, therefore Amex must be a terrible investment. This cognitive bias is a primary driver of market panics and manias. We overreact to recent news, to dramatic events, and to scary headlines because they are emotionally charged and easy to remember. We underweight the slow, boring, and consistent data that reflects the true, long-term fundamentals of a business. Buffett's information diet is a direct countermeasure to the availability heuristic. By spending the majority of his time reading business histories, annual reports, and trade journals, he populates his mind with a deep well of base-rate information. He understands the normal course of business, the historical resilience of strong brands, and the typical patterns of market overreaction. When a crisis hits, his brain doesn't just retrieve the recent, scary headline. It retrieves decades of context. It can place the current event within a much broader historical and industrial framework. He is able to ask, is this truly a company-killing event? Or is this another instance of market panic that I've read about a dozen times before? This ability to override the brain's lazy, shortcut-driven response with a more deliberate, context-rich analysis is a direct result of his continuous learning and reading habits. It is a practiced skill, a form of mental training that provides an enormous edge in a market driven by emotion and short-term thinking. So how can an ordinary investor apply this principle? How can you build an information diet that counters cognitive biases and fosters deep understanding? The blueprint is what we can call the information pyramid. It's a mental model for structuring your learning process, ensuring you build a strong foundation before you ever get to a specific stock tip. The pyramid has 3 layers, and you must build it from the bottom up. The base of the pyramid, the widest and most important layer, is broad, timeless knowledge. This is the lattice work Charlie Munger talks about. This layer isn't about investing at all, it's about understanding the world. It includes reading deeply in fields like psychology, history, biology, and physics. Why? Because the market is a complex, adaptive system driven by human behavior. Reading psychology, like Daniel Kahneman's Thinking, Fast and Slow, gives you a user's manual for the irrational minds that set market prices. Reading history, especially financial history like manias, panics, and crashes, shows you that while the players and technologies change, the script of human greed and fear remains remarkably consistent. Reading biology helps you understand concepts like ecosystems and survival of the fittest, which are perfect analogies for competitive dynamics in an industry. Your goal at this stage is to collect the great mental models from all disciplines. You should be spending at least 50% of your investment research time here, building the intellectual tools you'll need to analyze anything. This is the foundation of true financial literacy. The middle layer of the pyramid is industry-level knowledge. Once you have a broad understanding of how the world works, you can begin to focus on specific industries that interest you. This is where you graduate to the CEO mindset. Your goal is to understand an industry so well that you could hold a reasonably intelligent conversation with the CEO of any company within it. This means you must go beyond the Wall Street Journal. You must find and read the trade journals for that industry. If you're interested in insurance, you read National Underwriter. If you're interested in railroads, you read Railway Age. These publications cover the nitty-gritty details, the regulatory changes, the technological shifts, and the competitive chatter that never make it into the mainstream financial press. You should study the history of the industry. Who were the big players 10 or 20 years ago? What happened to them? What are the key drivers of profitability? Is it scale? A brand? A patent? This stage is about mapping the entire competitive landscape before you pick a horse to bet on. This is where you develop an information advantage, because 99% of your competition is not willing to do this level of work. Only after you have built the first 2 layers do you reach the tip of the pyramid, company-specific knowledge. This is where you finally read the 10 kilos second, the annual reports, and the quarterly earnings calls. But now, you are reading them with a completely different perspective. You are not just looking at the numbers in a vacuum. You are placing them within the context of the industry you now understand and the broad mental models you have collected. When you see a rising margin, you'll know if it's because of a durable competitive advantage you learned about in a trade journal, or a temporary industry tailwind that's about to reverse. When management talks about their strategy, you'll be able to judge it against the historical successes and failures of the industry you've studied. This is the final step of due diligence. By building your knowledge from the base up, you transform yourself from a passive stock picker into a genuine business analyst. The antithesis of this approach, the path of the 99%, is to live entirely at the tiny tip of this pyramid. This is the path of the stock tip chaser. Their process begins not with a desire for understanding, but with a trigger, a ticker symbol they see on a financial news network, a stock mentioned in a viral social media post, or a hot pick from a newsletter. Their research, if you can call it that, consists of a frantic, shallow dive into the most immediately available data. They'll look at the one-year price chart. They'll look at the headline revenue and earnings numbers from the last quarter. They'll read a few analyst ratings. They operate under the illusion that this surface-level data constitutes meaningful investment research. Imagine an investor, let's call him Tom, who hears about a new electric vehicle company. The stock is soaring, the headlines are glowing, and the CEO is a media darling. Tom, driven by a fear of missing out, immediately buys shares. He has no broad knowledge of manufacturing history, so he doesn't appreciate the immense capital expenditure and logistical complexity involved in scaling automobile production, a concept known as production hell. He has done no deep industry-level research, so he is unaware of the dozens of other well-funded competitors entering the same space, or the coming price wars that will crush margins across the industry. He has only lived at the tip of the pyramid, reacting to the stock price and the narrative. When the company inevitably hits a production snag, when a competitor releases a better battery, or when the market sentiment shifts, the stock plummets. Tom, having no deep conviction based on fundamental understanding, panics and sells at a huge loss. He blames the market, the CEO, or bad luck. But the real cause of his failure was his information process. He started with the answer, the stock, and tried to justify it, rather than starting with a question, is this a good business in a good industry? And doing the work to find the answer. This is the path to consistent losses and perpetual anxiety. The direct financial connection of Buffett's approach is profound, and the American Express story illustrates it perfectly. By building a broad knowledge base, he was able to accurately identify and value an intangible asset that the rest of the market, blinded by the availability heuristic, was pricing at zero. That asset was the brand trust of American Express. On a balance sheet, brand value is often listed under goodwill or other intangible assets, line items that many quantitative analysts dismiss or undervalue. But Buffett, through his on-the-ground research and his understanding of consumer psychology, knew that this particular intangible asset was the source of the company's entire economic engine. It was what allowed them to charge merchants a fee for transactions and sell travelers' checks with a float. It was a license to print money. The market, in its panic, was valuing American Express as if its brand was worthless and it would lose all its future earnings. It was offering to sell the entire financial services empire for a price that was justified by just the troubled warehousing division. Buffett's superior information process allowed him to see the massive discrepancy between the price and the value. This insight translated directly into a massive financial advantage. He was able to purchase a stream of future cash flows, protected by one of the most powerful brands in the world, for a tiny fraction of its true worth. The ultimate result on his partnership's financial statements was a multi-fold return on capital. This is the tangible outcome of a superior information diet. It allows you to see sources of value that others miss, to remain rational when others are panicking, and to allocate capital with a degree of conviction that is simply unavailable to those who live at the top of the information pyramid. The second great pillar of Buffett's information diet is, perhaps, even more important than the first. It is the art of filtration, the deliberate and ruthless practice of saying no. If the first pillar is about what to let in, this second pillar is about what to keep out. In an age of information overload, where we are bombarded with a ceaseless torrent of data, news, and opinions, the ability to ignore the irrelevant is a critical survival skill for an investor. Buffett's desk may be piled high with paper, but his mind is remarkably uncluttered. This is because he has a highly effective and very famous mental filter, the circle of competence. He has spent a lifetime identifying the businesses and industries he can understand, and has made a conscious, disciplined decision to ignore everything else. This isn't laziness, it's intellectual honesty. It's the recognition that the human mind has limits, and that true mastery is found in depth, not breadth. The most powerful demonstration of this principle was not a brilliant investment he made, but the thousands of tempting investments he refused to make during the single greatest speculative mania of our lifetime, the dot-com bubble of the late 1990s. The late 1990s were a euphoric, dizzying time. The internet was changing the world, and a new breed of technology company, the dot-com, promised to usher in a new era of permanent prosperity. Stocks of companies with no profits and often no revenue were doubling and tripling in value overnight. All you needed was a .com in your name and a vague business plan sketched on a napkin to command a billion-dollar valuation. It was a nationwide gold rush, and anyone who wasn't participating was seen as a fool. And at the center of this mockery was Warren Buffett. The media, once worshipful, turned on him with a vengeance. Barron's ran a now infamous cover story in 1999 titled, "What's Wrong, Warren?" The article declared him out of touch, a relic from a bygone era of smokestack industries, a man who simply didn't get the new paradigm. Analysts and fund managers ridiculed his refusal to invest in the high-flying tech stocks. They said he was too old, too timid, a dinosaur who was about to be rendered extinct by the meteor of technological innovation. The pressure to join the party was immense. His own shareholders at the Berkshire Hathaway annual meeting questioned his strategy. His performance was lagging the S&P 500, which was being rocket-fueled by tech stocks. Every instinct for social conformity, every ounce of professional pride was being tested. And yet, Buffett did nothing. He calmly sat in Omaha and continued reading about businesses like insurance, furniture, retail, and soft drinks. He said no to Cisco, no to Yahoo, no to Pets.com. Why? Not because he thought they were all bad businesses. In his famous 1999 speech at Sun Valley, he acknowledged that the internet would change the world and that great fortunes would be made. The reason he said no was simple. They were outside his circle of competence. He admitted, with profound intellectual honesty, that he had no special insight into the long-term competitive dynamics of the technology industry. He couldn't confidently predict which of the hundreds of competing tech companies would be the winners in 10 or 20 years. He couldn't reliably estimate their future cash flows, and therefore, he couldn't determine a sensible price to pay for them. He famously said, "The most important thing to do, if you find yourself in a hole, is to stop digging." For him, investing in an industry he didn't understand was like digging in a hole, so he simply put them all in his too-hard pile. He was willing to endure the short-term pain of underperformance and public ridicule in order to adhere to his lifelong discipline of only playing games he knew he could win. The outcome, of course, is now history. In early 2000, the bubble burst. The Nasdaq, which had soared above 5,000, collapsed by nearly 80%. Hundreds of dot-com companies went bankrupt, wiping out trillions of dollars in shareholder value. And Warren Buffett, the dinosaur, was left standing with a mountain of cash, ready to buy the wonderful, old economy businesses that had been thrown out with the bathwater. His discipline of filtration didn't just save him from losses, it armed him with the capital to seize the opportunities that followed the crash. The underlying psychological principles that Buffett battled during the dot-com bubble are two of the most powerful forces in human nature: social proof and FOMO, the fear of missing out. Social proof is our innate tendency to assume that the actions of others reflect the correct behavior for a given situation. When everyone around you is getting rich buying tech stocks, your brain's default assumption is that they must know something you don't. It feels safer to follow the herd than to stand alone, even if the herd is running towards a cliff. This is a deep-seated survival instinct from our evolutionary past, where straying from the tribe could mean death. In the modern world of finance, it leads to speculative bubbles. FOMO is the emotional engine that powers social proof. It's that anxious, gut-wrenching feeling that others are experiencing rewarding opportunities from which you are absent. The late 90s were a FOMO-generating machine. Stories of secretaries becoming millionaires and college kids buying Porsches were everywhere. This triggers a primal fear of being left behind, of losing your place in the social hierarchy. It short-circuits the rational part of our brain and puts the emotional, impulsive part in charge. The circle of competence is a pre-commitment device, a psychological firewall against these destructive forces. By defining in advance what you know and what you don't know, you create a clear, objective rule for your behavior. When a tempting popular stock appears that is outside your circle, you don't have to engage in a willpower-draining battle against FOMO and social proof. You can simply say, "This is not my game," and discard it. It transforms a difficult emotional decision into a simple, binary choice. This mental discipline, this art of saying no, is a form of self-improvement for investors that is far more valuable than any stock-picking algorithm. It is a defense mechanism for your capital and your sanity. The applied mental model for this pillar, the blueprint for creating your own psychological firewall, is the three-bucket system for information triage. It's a simple but incredibly effective way to manage information flow and enforce the discipline of the circle of competence. You need to mentally, or even physically, sort every potential investment idea into one of three buckets. The first is the IN bucket. This bucket is for businesses that fall squarely within your circle of competence. Your circle might be based on your profession, your hobbies, or an area you have deliberately studied for years. If you're a doctor, you might have an edge in understanding healthcare companies. If you're a software developer, you'll have a better grasp of a tech business. The key is that you must have a deep, almost proprietary understanding of the business model and its competitive landscape. This bucket should be, by design, very small. This is where you will do your most intensive due diligence and where you will look to make your investments. The second is the OT bucket. This bucket is for businesses that you know you will never understand. For most people, this might include things like complex biotechnology, speculative mining operations, or esoteric financial derivatives. The defining feature of the OT bucket is that you lack the fundamental background to even begin to analyze the business intelligently. The crucial step here is to be brutally honest with yourself. There is no shame in admitting ignorance. In fact, in investing, it is a source of strength. By placing a company in the OT bucket, you are making a permanent decision to ignore it. You will not read its news, you will not track its stock price, you will not listen to experts pontificate about it. You are freeing up your most valuable resource, your mental energy, to focus on the IN bucket. The third and perhaps most important bucket is the too hard bucket. This is the bucket that saves you from the biggest mistakes. The too hard bucket is for businesses that you could theoretically understand, but for which the future is simply too uncertain or too complex to reliably predict. Most technology companies in the late 1990s fell into this category for Buffett. He could understand what they did, but he couldn't predict the long-term winners and losers. A company in an industry with rapid technological change, fierce competition, or a heavy reliance on a single charismatic leader might go in this bucket. The airline industry is a classic example that Buffett has historically placed in the too hard bucket due to its brutal competition, high fixed costs, and vulnerability to oil prices. The act of placing a company in the too hard bucket is an acknowledgement of risk and a vote for intellectual humility. By rigorously applying this three-bucket system, you transform your information diet from a chaotic fire hose into a disciplined, focused stream, aimed only at targets you have a real chance of hitting. The antithesis to this disciplined filtration is the path of the 99%, which can be described as the diversification trap. The common wisdom peddled to amateur investors is diversify, diversify, diversify. They are told to own a little bit of everything to reduce risk. But for many, this translates into a portfolio of dozens or even hundreds of stocks they know absolutely nothing about. They own a tech stock because they feel they need tech exposure. They own a biotech stock because it seems like a growth area. They own an international stock to be globally diversified. Their portfolio becomes a random assortment of popular tickers, a museum of past market fads. This is not diversification. It is, as Peter Lynch called it, diversification. They have all the downside of owning stocks, the volatility and the risk of loss, but none of the upside that comes from concentrated, high-conviction bets in businesses they deeply understand. Their knowledge of each holding is an inch deep and a mile wide. When one of their stocks goes down, they have no basis for deciding whether to buy more or sell. Their only guide is the price action and the news headlines, which inevitably leads them to sell at the bottom. This approach guarantees mediocrity. By trying to play in every game, they ensure they have no edge in any of them. They are the poker player who tries to play every single hand dealt to them. They will inevitably be ground down by the patient players who wait for the premium hands. Buffett's approach is the exact opposite. He advocates for what he calls focus investing. He would rather own a handful of wonderful businesses he understands completely than 100 mediocre ones he doesn't. The direct financial connection of the circle of competence is twofold: catastrophic loss avoidance and the preservation of opportunity capital. The most obvious financial benefit is avoiding the big mistake. By saying no to the entire dot-com sector, Buffett avoided the 70 to 80% losses that wiped out many investors. The mathematics of loss are brutal. If you lose 50% of your capital, you need to make a 100% return just to get back to even. Avoiding that kind of devastating setback is the single most important factor in long-term compounding. A simple look at Berkshire Hathaway's balance sheet from 1999 to 2002 shows the tangible result. While the rest of the market's asset values were collapsing, Berkshire's book value and cash reserves remained robust. This leads to the second, more subtle financial advantage. By preserving his capital during the bust, he had a massive war chest of cash ready to deploy when the panic reached its peak. The financial landscape after the bubble burst was littered with the wreckage of great businesses whose stock prices had been decimated. He was able to step in and buy these wonderful companies at bargain basement prices, setting the stage for the next decade of phenomenal returns. Capital is a finite resource. By not squandering it on speculative bets outside his circle of competence, he ensured that it was available for the once-in-a-generation opportunities that fell squarely within it. In this way, the discipline of saying no directly translates into the financial firepower to say a very big yes at the exact right moment. That is the ultimate financial advantage of a filtered information diet. The third pillar of Buffett's information diet is perhaps the most intellectually demanding, but also the most rewarding. It is the art of synthesis. It's not enough to simply consume vast amounts of broad information, Pillar 1, and filter out the noise, Pillar 2. The true magic happens when you begin to connect the seemingly unrelated dots from your diverse reading to form a unique, proprietary insight. This is the process of building the mosaic. A single piece of tile, a number from a 10K, an anecdote from a biography, a trend from a trade journal is of limited value on its own. But when you combine them, when you see how they fit together, you can create a picture of a business that is far richer and more accurate than the one seen by the siloed specialists on Wall Street. Buffett's genius is not just in finding the tiles, but in arranging them into a coherent masterpiece. A quintessential example of this synthesis in action, a moment where connecting disparate ideas led to one of his most profitable and instructive investments, was the acquisition of See's Candies in 1972. On the surface, See's Candies was an unremarkable business. It was a family-owned chain of candy shops in California. When Buffett and Munger were first presented with the opportunity to buy it, their initial reaction was lukewarm. The numbers were decent, but not spectacular. The company was earning about $2 million a year pre-tax, and the sellers were asking for $25 million. The tangible assets, the factories, the inventory, the stores, were only worth about $8 million. For a classic value investor trained in the school of Ben Graham, paying a price more than 3 times the book value for a box of chocolates company seemed ludicrous. The Graham and Dodd approach, which focused on buying companies for less than their liquidation value, would have immediately rejected the deal. This is where the 99% of investors would have stopped. They would have looked at the balance sheet, seen the high price relative to the hard assets, and moved on. But Buffett's information diet was broader than just balance sheets. He had been reading not just about financial statements but about brands, consumer psychology, and the nature of competitive advantage. He and Munger began to synthesize information from multiple domains. First, they looked at the financial data. The company had required very little new capital to grow its earnings for years. This was a capital-light business. Second, they looked at the product and its customers, engaging in the same kind of on-the-ground due diligence they had with American Express. They saw the long queues at the stores during holidays. They recognized the psychology at play. A man buying a box of chocolates for his sweetheart on Valentine's Day is not looking for the cheapest option. He is looking for a trusted, quality brand to show he cares. He is not price sensitive. This was another tile. Pricing power rooted in customer emotion. Third, they thought about the brand from a historical perspective. See's had been around for decades. It had become a California institution, deeply embedded in the cultural fabric of the state. It was a brand associated with nostalgia, quality, and special occasions. This was a third, crucial tile, a powerful, durable brand moat that was almost impossible for a competitor to replicate. Now Buffett connected these tiles. He synthesized the financial data, capital light, with the psychological insight, pricing power, and the historical context, durable brand. He realized that the most valuable asset of See's Candies did not appear on the balance sheet at all. It was the brand name floating in the minds of millions of customers. The market, and even the sellers, were valuing the company based on its $8 million of tangible assets. Buffett realized the $17 million difference wasn't goodwill in an accounting sense. It was a massive, untapped economic engine. He saw that they could raise prices year after year without losing customers, and that the incremental profit would require almost no new capital investment. This synthesis of financial, psychological, and qualitative information allowed him to see a picture of a phenomenal business that the specialists missed. They bought See's for $25 million. Since then, it has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring minimal new investment. It was the investment that taught him it was better to buy a wonderful company at a fair price than a fair company at a wonderful price. The underlying psychological principle at work here is pattern recognition, which is fueled by a process called associative thinking. Our brains are not like computers, which store data in discrete, isolated folders. Our brains are vast, interconnected networks of neurons. A memory or a piece of knowledge is not a single file, but a specific pattern of connections between thousands of neurons. Learning and intelligence are, in large part, the process of forming new connections between existing patterns. When you read something new, your brain tries to link it to things you already know. The broader and more diverse your existing knowledge base, your lattice work, the more potential connections you can make. A specialist whose knowledge is deep but narrow has fewer nodes in their network to connect a new piece of information to. Their thinking is siloed. Buffett, by reading voraciously across many disciplines, has built an extraordinarily rich and dense neural network. When he learns about the pricing power of See's Candies, his brain doesn't just connect it to other candy companies. It connects to patterns he's learned from reading about newspapers with local monopolies, from studying the psychology of brand loyalty, and from observing the human tendency to use mental shortcuts, like expensive equals quality, in purchasing decisions. This ability to form novel associations between disparate ideas is the very essence of insight. It allows him to recognize a familiar pattern, a powerful consumer moat in a completely new context. His information diet is not just about accumulating facts, it is about building a brain that is optimized for pattern recognition and synthesis. This is the true definition of how to get smarter in the context of investing. The applied mental model for developing this skill of synthesis is the journalistic inquiry method. Instead of approaching a potential investment like a stock analyst, you must approach it like an investigative journalist trying to understand the entire story of the business. A journalist doesn't just look at the final score of a game. They interview the players, the coaches, the fans, and the concession stand owners to understand the whole ecosystem. For any business you analyze, you must force yourself to answer a series of probing questions that connect different domains. Start with the customer. Who are they, really? What job are they hiring this product to do? What is the emotional driver behind their purchase? Don't just read market research reports. Try to talk to actual customers or observe them. Next, follow the supply chain. What are the raw materials? Where do they come from? Are there any bottlenecks or dependencies? This forces you to think about the business's vulnerabilities. Then, map the distribution. How does the product actually get from the factory to the customer? Who are the middlemen? Who has the power in that relationship? This can reveal hidden risks or profit centers. Finally, investigate the information flow. Where do people in this industry get their news and ideas? Read the same trade journals the CEO reads. Attend an industry conference if you can. The goal of this method is to force you to gather tiles from different mosaics, customer psychology, logistics, industrial organization, and then sit down and consciously try to piece them together. You should write down your findings, trying to explain in simple language how the company's financial results are a direct consequence of its relationships with its customers, suppliers, and competitors. This process of forced synthesis builds the mental muscles required to see the whole picture. The antithesis of this synthetic approach is the siloed analyst mindset, which dominates the professional investment world and is mimicked by many amateurs. Wall Street is structured into silos. There are retail analysts who cover consumer trends. There are industrial analysts who cover manufacturing. There are quantitative analysts who build financial models. They are experts in their narrow domains, but they rarely talk to each other. Their information and their thinking remain compartmentalized. The quant looks at the numbers for See's Candies and sees an overvalued company based on its tangible assets. The retail analyst might see a strong brand, but has no way to quantify its financial impact. They each hold a different tile from the mosaic, but no one is responsible for putting the whole picture together. This leads to massive blind spots. They miss the crucial insight that it is the times interaction times between the brand loyalty and the capital-light financial structure that makes the business truly exceptional. The amateur investor who tries to emulate this professional world often falls into the same trap. They might have a spreadsheet with all the financial ratios, but they haven't done the qualitative work to understand the why behind those numbers. They see the what but not the how. They are tile collectors, not mosaic builders. This siloed thinking guarantees that they will only ever see the obvious, and in investing, the obvious is almost always correctly priced. The real money is made by seeing the connections that others miss. The direct financial connection of synthesis is the accurate valuation of intangible assets, which often leads to the discovery of extraordinary pricing power. As with the American Express example, the See's Candy story shows how synthesis allows an investor to put a real financial value on something the balance sheet barely acknowledges. The ability of See's to consistently raise prices without a corresponding increase in its capital base is a financial superpower. This translates directly to an ever-increasing return on invested capital, ROIC, one of the key metrics Buffett looks for. Let's quantify this. Imagine See's earns $2 million on $8 million of tangible assets, a 25% return. If they can raise prices by 10% next year, and it flows straight to the bottom line because costs don't increase, they now earn $2.2 million on the same $8 million of assets. The return jumps to 27.5%. This extra profit requires no new investment. It is a pure gift of the brand. A business that can do this year after year is a compounding machine. By synthesizing the qualitative data about the brand with the quantitative financial data, Buffett was able to foresee this future stream of high-return cash flows. He was buying not just the current earnings but the option types to effortlessly increase those earnings for decades to come. This is how a deep, synthetic understanding of a business translates into a tangible and massive financial advantage. It allows you to identify businesses whose future financial performance will be dramatically better than their past performance would suggest. A secret hidden in plain sight, visible only to those who can assemble the mosaic. The fourth pillar of Buffett's information diet is a concept that is simple to understand but incredibly difficult to practice in our hyper-connected world: time arbitrage. This is the strategy of focusing one's attention and reading on information that has a long shelf life, while systematically ignoring the short-term noise that obsesses the majority of market participants. Buffett isn't trying to predict what a stock will do tomorrow, next week, or next quarter. He is trying to understand what a business will look like in a decade. This long-term perspective dictates his entire information diet. He prioritizes reading annual reports, business biographies, and industry histories, documents whose insights remain relevant for years, over listening to the ephemeral chatter of daily financial news, which is obsolete in hours. He is playing a different game, on a different time horizon, and this gives him a structural advantage over the twitchy, short-term-oriented players who dominate the market. A powerful example of this time arbitrage in action was his investment in the Washington Post Company in the early 1970s. In 1973, the stock market was in a brutal bear market, and the Washington Post was facing a storm of short-term negativity. The company had just gone public. The Watergate scandal, which its reporters had broken, was a source of immense political pressure. On top of that, the company was facing a potential strike at its press rooms. The market, with its typical myopia, focused obsessively on these immediate headwinds. Wall Street analysts worried that the political blowback from Watergate would harm the business and that a strike would cripple production. The stock price was hammered, falling to a level that valued the entire company at just $80 million. The 99% of investors consuming a diet of daily headlines and fearful analyst reports were selling, but Warren Buffett was buying. He was consuming a different set of information. He had read the company's financials for years. He understood that the Washington Post was not just a newspaper. It was a local institution with a near monopoly on print advertising in the nation's capital. It was the dominant source of information for an affluent and influential readership. He had also read the biography of its legendary publisher, Katharine Graham, and had immense respect for her integrity and business acumen. His information diet was focused on the long-term, durable characteristics of the business. He asked himself questions that transcended the daily news cycle. Will people in Washington, D.C. still want to read a local newspaper in 10 years? Yes. Will businesses still need to advertise to reach those people? Yes. Does this newspaper have a powerful competitive advantage that protects it from rivals? Yes. Its local dominance was a powerful moat. He recognized that the company also owned other valuable assets, including Newsweek magazine and several television stations, which the market was essentially giving him for free at that price. The short-term problems, the political heat from Watergate, the potential strike, were, in his long-term view, just blips. They were temporary storms that would pass, leaving the strong, durable fortress of the business intact. He invested over $10 million, a significant sum for him at the time, buying up a large stake in the company. He was engaging in time arbitrage. He was buying a long-term certainty at a price that reflected short-term fear. His conviction was rooted in information that had a long shelf life, the nature of media monopolies, rather than information with a short shelf life, today's political headline. The investment was a monumental success. Over the next 30 years, the value of his stake grew more than 100-fold, becoming one of the cornerstones of Berkshire Hathaway's wealth. The psychological bias that Buffett exploits with this strategy is a combination of myopia and hyperbolic discounting. Myopia, in a psychological sense, is our tendency to be short-sighted, to focus on what is directly in front of us and ignore the more distant future. Hyperbolic discounting is the specific cognitive quirk, where our brain values rewards that are closer to the present moment far more than rewards of equal or greater value in the future. We would rather have $50 today than $100 a year from now, even though the latter is objectively a much better deal. The financial media is a machine purpose-built to exploit this flaw in our mental wiring. It bombards us with breaking news, market alerts, and minute-by-minute updates, creating a sense of constant urgency. This diet of high-frequency information forces our brains into a state of perpetual short-term thinking. We become conditioned to react to every stimulus, to trade on every piece of news, to discount the future in favor of the present. Buffett's information diet is a deliberate rebellion against this. By choosing to read books, which take months or years to write, and annual reports, which reflect a full year of business activity, he is forcing his brain to operate on a different timescale. He is training his mind to ignore the tempting, immediate rewards of reacting to daily noise and to focus on the much larger, more certain rewards that come from understanding long-term business fundamentals. This knowledge compounding, the slow accumulation of timeless wisdom, allows him to patiently wait for opportunities where the market's hyperbolic discounting has created a massive gap between the short-term price and the long-term value. The applied mental model to cultivate this long-term perspective is the 5-year newspaper exercise. This is a powerful thought experiment you can perform before making any investment. Instead of reading today's newspaper or financial news website, take a moment and try to imagine the headlines of the business section 5 years from now. Sit down with a blank piece of paper and write down what you think the big stories about your target company and its industry will be. Will the headline be, "Company X misses quarterly earnings by 2 cents"? It's highly unlikely. That's short-term noise. Will the headline be, "Company X loses market share to new competitor"? Or Company X's brand recognized as most trusted in industry for 5th straight year? These are the kinds of headlines that reflect the long-term fundamentals that truly drive value. This exercise forces you to distinguish between the signal and the noise. The things that will matter in 5 years are the company's competitive advantage, the quality of its management, the strength of its brand, and its ability to innovate. The things that seem critically important today, the latest interest rate forecast, a minor product delay, a controversial tweet from the CEO, will likely be forgotten footnotes. By regularly practicing this exercise, you train your brain to filter information through a long-term lens. You begin to instinctively ask of any new piece of information, will this matter in 5 years? More often than not, the answer is no, and you can safely ignore it, preserving your focus for the information that truly counts. This is a core Warren Buffett habit for developing a CEO mindset. The antithesis of time arbitrage is the high-frequency trader mindset. This isn't just about the algorithmic trading firms. It's a mentality that has infected the majority of market participants. They are addicted to the constant stream of information. They have news alerts set up on their phones. They watch the stock ticker all day. Their emotional state rises and falls with every minor fluctuation in their portfolio's value. They believe that having more information, faster, gives them an edge. In reality, it does the exact opposite. It makes them a perpetual victim of myopia and hyperbolic discounting. They are constantly reacting, never reflecting. This constant churn has devastating financial consequences. First, it leads to terrible decision-making, buying at the peak of excitement and selling at the bottom of a panic. Second, it racks up enormous costs. Every trade generates a transaction fee. Every short-term gain is taxed at a higher rate than a long-term gain. This constant friction of costs and taxes acts as a powerful headwind, making it almost impossible to compound wealth effectively. The high-frequency mindset is a losing game, designed to enrich brokers and the financial media, not the investor. It is the perfect embodiment of being penny wise and pound foolish. chasing the small, fleeting gains of today at the expense of the life-changing wealth that comes from patient, long-term ownership of great businesses. The direct financial connection of time arbitrage is the ability to fully capture the power of compounding of intrinsic value. The intrinsic value of a great business, its true underlying worth, tends to grow at a relatively steady rate over time, much like a tree growing in a forest. Its stock price, on the other hand, is like a manic-depressive dog being taken for a walk by its owner, the intrinsic value. The dog runs wildly ahead, then falls far behind, zigs and zags, but over the long run, it follows the path of its owner. The investor with a short-term information diet is focused on the erratic movements of the dog. They try to guess its next zig or zag, an impossible task. The investor practicing time arbitrage, like Buffett, keeps their eyes firmly on the owner, the intrinsic value. Their information diet is designed to answer one question: is the owner still walking in the right direction at a good pace? As long as the intrinsic value of the business is compounding at a satisfactory rate, they can ignore the frantic antics of the stock price. This allows them to do two things that are critical for wealth creation. First, it allows them to hold on to their winners for years, even decades, letting the miracle of compounding work its magic without interruption from taxes and trading costs. Second, it gives them the fortitude to buy more when the dog of the stock price falls far behind the owner of intrinsic value, that is, when the market panics. Visually, you can imagine a chart with two lines. One is a smooth, upward-sloping line representing the growth of a company's intrinsic value. The other is a jagged, volatile line representing the stock price, oscillating wildly around the first line. Time arbitrage is the discipline of making your decisions based on the smooth line, not the jagged one. This is how long-term thinking translates directly into superior financial returns. The fifth and final pillar of the information diet is the bridge from knowledge to results. It is the principle of application, the process of converting this vast, synthesized, long-term knowledge into a single, decisive, and often highly concentrated action. All the reading in the world is useless if it doesn't lead to intelligent capital allocation. Buffett's system is not an academic exercise, it is a pragmatic machine for making money. This final pillar is about overcoming the inertia of analysis paralysis and having the conviction to act decisively when a rare opportunity presents itself. It's about ensuring that the output of your information diet isn't just a well-informed opinion, but a tangible entry in your portfolio. The ultimate demonstration of this principle came during the darkest days of the 2008 financial crisis, when Buffett transformed decades of accumulated knowledge into a series of bold actions that not only saved some of America's most important financial institutions, but also netted Berkshire Hathaway billions of dollars. In September of 2008, the global financial system was on the brink of collapse. Lehman Brothers had just filed for bankruptcy, the largest in U.S. history. AIG, the world's largest insurer, had been bailed out by the government. The credit markets were frozen solid, and fear was palpable. The information flow was a deafening siren of panic. Every newspaper, every television channel was broadcasting a message of impending doom. For most investors, the instinct was to sell everything, to flee to the safety of cash or gold. It was a moment of pure, unadulterated terror. But in Omaha, Warren Buffett was receiving phone calls. His lifetime of reading was not just about specific companies. He had deeply studied the history of financial panics. He had read about the panic of 1907, the Great Depression, and every major market crash in between. His information diet had prepared him for this exact moment. He understood the dynamics of fear and forced selling. He knew that in a liquidity crisis, even good assets get thrown overboard at absurd prices. He recognized the pattern, so when the phone rang, he was ready to act, not to panic. The first call was from Goldman Sachs, one of the most prestigious investment banks in the world. They were facing a crisis of confidence and needed capital, fast, to shore up their balance sheet and send a signal of stability to the market. While others saw Goldman as a toxic asset on the verge of failure, Buffett, Drawing on his deep knowledge of the financial system and the power of government intervention in a crisis, saw a durable franchise being offered at a moment of temporary distress. He agreed to invest $5 billion. But this wasn't just a simple stock purchase. His deep understanding allowed him to structure a deal that was a masterpiece of asymmetric risk. He bought $5 billion of preferred stock that paid a handsome 10% dividend, ensuring a strong income stream for Berkshire. More importantly, he received warrants that gave him the right to buy $5 billion of common stock at a fixed price in the future. This structure gave him immense upside if Goldman recovered, with a protected downside from the preferred dividend. A few weeks later, he made a similar deal with General Electric, another blue-chip company hammered by the crisis. And in 2011, he would make a similar $5 billion investment in Bank of America. These were not small tentative bets. These were massive, company-defining capital allocations made at the moment of maximum pessimism. It was the ultimate conversion of a lifetime of reading and learning into decisive, world-changing action. The psychological principle at play here is the battle between our action bias and the discipline of calculated inactivity. The action bias is our innate tendency to favor action over inaction, even when inaction is the more rational course. In a crisis, our brains scream at us to do something. For most investors, doing something means selling. It feels proactive, it feels like you're taking control, but it's often the worst possible decision. Buffett's approach flips this on its head. His default mode is calculated inactivity. For years, he can sit and do nothing, patiently reading and waiting, allowing cash to build up on his balance sheet. He is perfectly comfortable being inactive while he waits for what he calls the quote-quote "prot pitch," the rare, obvious opportunity. However, when that pitch arrives, he overcomes the fear-induced paralysis that grips most people and swings with tremendous force. The 2008 crisis was the fattest pitch of his lifetime. While everyone else was succumbing to the action bias of panic selling, he was executing on a plan he had been mentally preparing for his entire life. His deep knowledge base gave him the conviction to act when others were frozen with fear. It transformed his action from a panicked reaction into a deliberate, calculated strike. This ability to be patient for years and then violently active for a few weeks is a hallmark of his genius, and it is a direct product of an information diet that prioritizes deep understanding over frantic activity. The applied mental model for bridging the gap between analysis and action is the one-page thesis checklist. Before you are allowed to buy a single share of any stock, you must be able to distill all of your research and knowledge into a single, simple page. This page must clearly and concisely answer 4 questions. First, the business in a sentence. Can you describe what the company actually does in language a 10-year-old could understand? If you can't, you don't understand it well enough. For example, See's Candies sells boxed chocolates to customers who are not price-sensitive, primarily for gift-giving occasions. Second, the 3 key drivers of value. What are the 2 or 3 essential factors that will determine this company's success over the next decade? This forces you to separate the critical variables from the trivial ones. For the Washington Post, it might have been local advertising monopoly, trusted brand, and reader loyalty. Third, the main risks and why they are manageable. You must honestly articulate the biggest threats to the business and explain why you believe the company can withstand them. This prevents you from falling in love with your own idea. For American Express, the risk was brand damage, but Buffett's research showed it was manageable because it was contained to the warehousing division. Fourth, a conservative estimate of intrinsic value. Based on your analysis, what is a reasonable, conservative estimate of what the entire business is worth? And how does the current stock price compare to that value, providing a margin of safety? This final step connects your qualitative understanding to a quantitative decision. If you cannot fill out this one-page thesis with clarity and conviction, you have no business investing. This exercise acts as a final filter, ensuring that you are not just a collector of interesting information, but an investor ready to take decisive action. It is the final step of a robust financial education. The antithesis of this decisive application is the dreaded state of analysis paralysis. This is the investor who is the mirror image of the stock tip chaser. They do all the reading. They build the information pyramid. They understand their circle of competence. They can synthesize information, and they think long-term. They can fill binders with detailed research on a company. But they can never bring themselves to pull the trigger. They are always waiting for one more piece of information, one more confirmation, for the uncertainty to be resolved. They collect knowledge as an end in itself, like a stamp collector, rather than as a tool for action. While they are far more knowledgeable than the average investor, their financial results can be just as poor. Their portfolio consists of a large pile of cash that is constantly being eroded by inflation, and a long watch list of stocks that they almost bought before they went up 500%. Their failure is not one of intellect, but of temperament. They have mastered the research but have not cultivated the courage and conviction to act on it. While they avoid the catastrophic losses of the speculator, they also miss out entirely on the life-changing gains that come from acting boldly when opportunity presents itself. It is a quiet, slow form of portfolio death by inaction. The direct financial connection of this final pillar is the achievement of asymmetric risk/reward profiles. Look at the structure of the Goldman Sachs deal. Buffett's $5 billion had a limited, defined downside. As a preferred shareholder, he was first in line to get paid his 10% dividend. If the company went bankrupt, he would have a senior claim on the assets. The upside, however, was immense and almost unlimited. The warrants gave him the ability to participate in the full recovery of one of the world's premier financial institutions. He was risking $1 to potentially make 5 or 10. This is an asymmetric bet. These types of opportunities, with limited downside and massive upside, are exceedingly rare. They only appear in moments of extreme market dislocation, and they are only available to those who have done the work in advance. You cannot start your due diligence on Goldman Sachs in the middle of a panic. You must already have the knowledge base, the understanding of the financial system, and the capital ready to deploy. Your lifetime of reading is the premium you pay to get a seat at the table when these incredible deals are offered. The financial payoff is not just a good return, it is a transformational return, the kind that alters the trajectory of a company like Berkshire Hathaway. It is the ultimate cash-on-cash return for decades of disciplined investment in your own knowledge. You have made it to the end of this deep dive, and in doing so, you have invested something far more valuable than money. You have invested your time and your attention. What you have gained in return is not just a collection of anecdotes about a famous investor. You have acquired the blueprint for an entirely new operating system for your mind. You no longer need to be a passive consumer of financial news, a victim of the market's emotional whims. You now possess a 5-pillared system for converting raw information into actionable insight, for building a durable intellectual moat around your financial decisions. This framework, building a broad base, filtering the noise, synthesizing the connections, leveraging time, and acting with conviction, is a powerful tool for navigating not just the markets, but any complex decision in your life or business. But it is crucial to understand that what we have built together today is just one wing of a much larger mental palace. Buffett's system of information consumption is the foundation, the process by which he identifies wonderful businesses. It is a critical, indispensable piece of the puzzle, yet it is interconnected with a whole network of other mental models. Knowing a business is wonderful is only the first step. How do you then calculate with precision what it is actually worth? What is the framework he uses to determine a fair price? How does he manage the immense psychological pressure of holding billions of dollars in a single stock as it falls 50%? How does he think about managing people and creating a corporate culture that fosters this kind of rational, long-term thinking? Each of these questions is its own pillar, a separate but essential component of the complete architecture of his success. The video that is now appearing on your screen is not an accident. The algorithm has, in its own way, detected your commitment. It has recognized that you are seeking not just tips but systems. It has identified the next logical piece of this intellectual map. That video is the bridge from understanding the what a great business is, to understanding the how to value it, how to manage it, and how to hold it. It is the link that connects the library of the mind to the treasury of the bank account. The casual viewer, the information snacker, will click away now, satisfied with what they have learned. But you are not a casual viewer. You are on a different path. You are on the path to becoming a true investor, a strategic capital allocator, an architect of your own financial future. For someone on that journey, completing the mental arsenal is not optional. The next piece of the map is waiting for you. The only decision left is to continue your ascent. Click and complete the model.